In Chapter 6 of A Random Walk Down Wall Street by Burton G. Malkiel, titled Technical Analysis and the Random Walk Theory, Malkiel delves into the shortcomings of technical analysis, which seeks to predict stock price movements by analyzing past price data. The chapter critically examines various technical systems and their lack of consistent predictive power, while emphasizing the concept of a random walk in stock prices. Malkiel argues that price movements in efficient markets are random and unpredictable, debunking the idea that technical analysis can consistently provide an edge. Here's a detailed summary of the chapter. Holes in their shoes and ambiguity in their forecasts. Malkiel begins by highlighting the problems associated with technical analysts, those who rely on past stock prices and patterns to predict future movements. He describes the life of a typical technical analyst, noting that while they are often revered as market gurus, their predictions are frequently inconsistent, vague, or outright wrong. The chapter title, Holes in Their Shoes, humorously refers to the image of technical analysts running around trying to make predictions but often missing the mark. Their forecasts often rely on ambiguous chart patterns that can be interpreted in multiple ways, which is why their predictions sometimes lack accuracy. Is there momentum in the stock market? One of the central ideas behind technical analysis is that markets exhibit momentum, meaning that once a trend starts, it tends to continue for some time. Malkiel explores this notion by analyzing the concept of price momentum, which suggests that rising prices attract more buyers, leading to further price increases, and the reverse for falling prices. Technical analysts argue that by detecting these trends early, investors can profit from continued momentum. However, Malkiel casts doubt on this theory, pointing out that while there may be some short-term trends in the market, these are often random and not necessarily indicative of future price movements. He argues that in efficient markets, any trend that could be exploited for profit would quickly disappear as more investors attempt to capitalize on it. Just what exactly is a random walk? Malkiel then introduces the idea of a random walk, which is central to his critique of technical analysis. According to the random walk theory, stock prices move randomly and are unpredictable. The theory asserts that past price movements do not provide any useful information for predicting future prices, because stock prices already reflect all available information. The concept of a random walk challenges the very foundation of technical analysis, which relies on the belief that patterns and trends in past prices can be used to forecast future price movements. Malkiel argues that, in reality, stock prices follow a random pattern, making it impossible to consistently outperform the market using technical analysis. Some more elaborate technical systems. Malkiel explores a variety of more elaborate technical systems that have been developed in an attempt to beat the market. These include the filter system, the Dow theory, the relative strength system, and price-volume systems. Each of these systems has its own methodology, but they all share the common goal of using historical price data to make predictions. The filter system suggests that investors should buy a stock after it has risen by a certain percentage and sell it after it has fallen by a certain percentage. While this system might seem logical on the surface, Malkiel argues that it fails in practice because it is based on the assumption that trends will continue indefinitely, which is not always the case. Additionally, transaction costs can erode any potential profits from following this system. The Dow theory is one of the oldest forms of technical analysis and is based on the idea that stock market movements can be divided into three types of trends: primary trends, secondary trends, and daily fluctuations. According to the theory, the market's primary trend can be identified by observing the behavior of the Dow Jones Industrial Average and the Dow Jones Transportation Average. Malkiel notes that while the Dow theory has its followers, it has been shown to be unreliable in predicting future price movements. The relative strength system involves comparing the performance of individual stocks to the overall market or to other stocks. Technical analysts believe that stocks that have performed well in the past are likely to continue to outperform in the future. However, Malkiel argues that this system is flawed because it assumes that trends will persist, which is not always the case in a random market. Price-volume systems analyze the relationship between a stock's price and its trading volume. Technical analysts believe that increases in trading volume can signal the beginning of a new trend. While this system may work in certain cases, Malkiel points out that it is often difficult to distinguish between genuine price movements and random fluctuations. Chart patterns are a key tool used by technical analysts to predict future stock price movements. Common patterns include head and shoulders formations, double tops, triangles, and flags. Malkiel explains that these patterns are believed to signal changes in market trends and are used by technical analysts to time their trades. However, Malkiel is skeptical of the predictive power of chart patterns. He argues that many of these patterns are subjective and can be interpreted in different ways by different analysts. Furthermore, he suggests that any patterns that do exist are likely the result of random chance rather than meaningful trends. One of the reasons why technical analysis remains popular despite its lack of predictive power is that humans have a natural tendency to look for patterns, even in random data. Malkiel explains that people are hardwired to find meaning in sequences of numbers and events, which makes it difficult for them to accept the idea that stock prices move randomly. This tendency to see patterns where none exist leads many investors to believe that they can predict future stock prices based on past data. However, Malkiel argues that this belief is misguided, as stock prices follow a random walk and are therefore unpredictable. A gaggle of other technical theories to help you lose money. Malkiel humorously describes a number of other technical theories that have been developed over the years, all of which he believes are unlikely to help investors consistently make money. These include the hemline indicator, the Super Bowl indicator, the odd lot theory, the dogs of the Dow, and the January effect. The hemline indicator suggests that stock prices rise when women's hemlines become shorter and fall when they become longer. While this theory may be entertaining, Malkiel dismisses it as having no basis in reality. The Super Bowl indicator posits that the stock market will perform well if a team from the National Football Conference, or NFC, wins the Super Bowl, and poorly if a team from the American Football Conference, or AFC, wins. Like the hemline indicator, Malkiel views this theory as little more than a humorous coincidence. The odd lot theory is based on the idea that small investors who typically trade in odd lots, or less than 100 shares, are usually wrong in their market predictions. According to this theory, investors should do the opposite of what small investors are doing. Malkiel argues that this theory is based on a false assumption and does not provide any real predictive power. The dogs of the Dow strategy involves buying the 10 highest-yielding stocks in the Dow Jones Industrial Average at the beginning of each year. Malkiel explains that while this strategy has sometimes outperformed the market, it is not a reliable method for generating consistent returns. The January effect refers to the tendency for small-cap stocks to outperform large-cap stocks in January. While there is some historical evidence to support this phenomenon, Malkiel argues that it is not a reliable indicator of future performance as it has diminished over time. Malkiel briefly discusses a few more technical systems that have been developed in an attempt to beat the market. These include moving averages, stochastic oscillators, and Bollinger Bands. While these systems may work in certain cases, Malkiel argues that they are unlikely to provide a consistent edge in an efficient market. Technical market gurus. Despite the shortcomings of technical analysis, Malkiel acknowledges that there are still many market gurus who promote the use of technical systems. These gurus often claim to have discovered new methods for predicting stock prices, and they attract a large following of investors who are eager to learn their secrets. Malkiel is skeptical of these claims, noting that many of these gurus have a vested interest in promoting their systems, as they often sell books, newsletters, or investment services. He cautions investors against blindly following the advice of market gurus, as their predictions are often based on flawed reasoning. Why are technicians still hired? Malkiel raises an important question. If technical analysis is so flawed, why do so many investment firms continue to hire technical analysts? He suggests that part of the reason is that technical analysis provides a sense of certainty in an uncertain market. Investors are drawn to the idea that they can predict the future based on past data, even if this belief is not supported by evidence. Additionally, Malkiel explains that technical analysts can sometimes be useful in the short term, particularly in highly volatile markets. However, he cautions that their long-term track record is generally poor. Appraising the counterattack. Malkiel acknowledges that some critics of the random walk theory argue that markets are not perfectly efficient, and that technical analysis can sometimes provide valuable insights. However, he counters that even if markets are not perfectly efficient, they are efficient enough to make it extremely difficult for any investor to consistently outperform the market using technical analysis. Malkiel wraps up the counterattack on the random walk theory by addressing common criticisms, particularly from technical analysts. Despite some valid points about occasional inefficiencies in the market, Malkiel maintains that these anomalies are rare and difficult to exploit for sustained profit. His final word on the matter is clear. While no system is perfect, the weight of evidence suggests that markets are largely efficient, meaning that price movements are random and cannot be consistently predicted using technical systems. Implications for investors. Malkiel concludes the chapter by discussing the implications of his arguments for investors. He warns that technical analysis is unlikely to help the average investor consistently outperform the market. Instead, Malkiel advocates for a more passive investment strategy, such as investing in index funds, which allows investors to capture the overall performance of the market without attempting to time their trades or predict future price movements. Chapter highlights recap. Technical analysis flaws. Malkiel begins by highlighting the fundamental shortcomings of technical analysis, arguing that stock price movements are unpredictable and random. Variety of systems. Various technical systems, including the filter system, Dow theory, relative strength, and others, are explored, with Malkiel pointing out their limitations. Randomness of stock prices. The random walk theory is central to Malkiel's argument, suggesting that past price movements do not provide useful information for predicting future prices. Pattern recognition flaws. Malkiel debunks popular chart patterns and technical theories, from the hemline indicator to the Super Bowl indicator, as being unreliable and sometimes laughable. Market gurus. Despite the flaws in technical analysis, Malkiel notes that market gurus promoting technical systems continue to attract a large following, though their advice often lacks a solid foundation. Random walk theory's strength. Malkiel defends the random walk theory, asserting that even though markets may not be perfectly efficient, they are efficient enough to make technical analysis ineffective for consistent long-term success. Conclusion. In this chapter, Burton Malkiel dismantles the arguments in favor of technical analysis and reaffirms the random walk theory. The essence of his argument is that stock prices are random and cannot be predicted using past price data or elaborate technical systems. Malkiel offers ample evidence to show that while technical analysis may provide comfort or temporary success, it is not a reliable strategy for long-term investing success. Instead, Malkiel encourages investors to adopt a passive investment strategy, focusing on broad market index funds that allow them to capture the overall market performance without relying on speculative systems. For the average investor, embracing the random walk theory means accepting that trying to beat the market is a futile exercise. Instead, staying the course with diversified, low-cost investments is the wisest course of action. The key takeaway from this chapter is clear. Don't waste time and money chasing after complex technical systems or patterns. Stock prices are random, and the best strategy is to invest in the broader market and avoid speculative attempts to predict future price movements.
Thank you for watching. Share this with friends and family, and please subscribe.